Traders at UBA expect Nigeria's bond market to open next week on a calm note with a slight bearish bias as traders digest the probable impact of the new supplementary fiscal budget proposed by the Nigerian government on bond yields. Dumebi Udegbunam, fixed income trader at UBA, joins me now to give us his thoughts on the market. Thank you so much, Dumebi, for joining us. So let's unpack the likely impact of a supplementary budget on bond yields. Obviously, the issuing calendar of the government impacts the supply of bonds to the market. How do you see things playing out in the bond market in the context of this supplementary budget that is being proposed?
Good afternoon, Wale. Thanks for having me. So if you notice, the budget passed earlier this year, we had an expenditure of 13 trillion and a revenue of 7 trillion, which leaves us with a deficit of 5.9 trillion. So if you add this 2.02 billion into the budget, we'll have an increased deficit of about 6.3 trillion. Mind you, our debt stock has increased in Q1 by 0.65%. So all this means right now is we are planning to borrow more to get us out of the recession and also to fund the vaccine and military impacts that we want to have right now. So what this means is higher yields going forward, as we've seen in the last three auctions we've had in the market, and the 2045, the 2049, and 2050 had they've hinged up higher. So what this means is higher yields. That's why going into next week we will see more bearish sentiments as the market participants will sell on the back of this new information, where the government might try and fund the deficits which has increased from this borrowing.
Of course, inflation data is another factor that many investors consider as they look at the markets here. Now, we know that inflation has been high, and the broad expectation is that it will remain high while we wait for the latest inflation data to be released, probably next week. Your thoughts on the likely direction of yields in the context of inflation? Do you expect, for example, that we may have a situation where we are now having real returns on fixed income instruments? Do you think that yields could move up that high?
Yields could move up that high, but it's too sudden to say so. Yields will move on marginally. We will still have a negative rate of return, but it's not as fast as we emphasize or we predict it might be. This is still just the second quarter of the year. Let's see how we go into Q3, Q4. Mind you, the IMF has also projected a growth forecast of 5.6 with Nigeria at 1.5. What that means is as the economy grows and open up, we'll probably see a taper down in the inflation figures. So yes, we might still see a negative rate of return to end the last month of the quarter, but we might not see a positive going into Q3. Probably, let's say Q4.
All right. And earlier I mentioned that you have a somewhat negative bias, or should I say bearish bias for next week in terms of how yields are likely to trend. But I wanted to hear your thoughts on liquidity in general, the dynamics that we're seeing. I think earlier in the year there was a lot of concern about excess liquidity, but now it seems that is less the case. What exactly do you think has changed that fundamentally suggests that we might see tightness moving forward?
Two things. We've received regular CRR debits from the CBN and also an appetite in the market. The market is not as active as we used to have it before. Reason being, if you noticed, our general trading rating has reduced to a B negative, which is a high speculative, which means the foreign portfolio investors are not really confident where our market is, coming from two things: the inflation figures coming from where our inflation is, our rates right now is in the treasury bills market. We have rates as high as 9%, while inflation is as high as 18%. So that's a real negative rate of return. And then the political instability and insecurity, and also a drop in our balance of payment, which is negative. We are a net importer. So all this put together in a basket of ideas poses a really negative outcome for liquidity going forward. So all this will see a taper down in the volatility or in the prosperity of the market, which has caused an illiquid situation in the market. So this might continue going forward if peradventure we have a boost in activities and also a boost in yields, which might be more attractive to investors. If you compare our yields weighting amongst other emerging markets, like let's say Egypt and other markets in Africa, ours is not as the top 5 best. So we see foreign portfolio investors going into the market, which has made our market not as deep as we used to have it. So all these factors put together has more or less tapered down into the illiquidity constraint we're having right now.
All right, let's talk briefly about the foreign exchange market. We are seeing FX reserves slip to about $35 billion as at 9th of June. I'm sure that trend is beginning to concern a lot of market watchers and traders. First of all, I want you to speak to the dynamics that we're seeing in terms of how the central bank is trying to supply the market. But of course, the dilemma is that as you supply the market more, we are putting more pressure on those reserves.
Okay, so like I earlier said, so our reserves are going down due to two things. Like you first said, the CBN is funding the INE window. We've seen rates stable around 410, 420, and also we are not generating as much FX as we are. Like I earlier said, we're a net importer. Our export figures as at Q1 2021 was 2.3 trillion compared to our import figures of 6.3, which is a negative BOT, a negative balance of payment of negative 3.2 trillion. So that means we are not generating or we are not holding in more inflows in FX as we used to compared to 2019 and compared to previous year 2018. So that also too has tapered into our foreign reserve situation. So going forward, we expect this to keep on happening. However, there are likelihoods of growth in the manufacturing sector. Our PMI has gone up year on year about 0.65% up from where we previously are. So the issue of the question right now is how fast can we grow to catch up to that, to be able to cover the balance of payment, the negative balance of payment to surge up or to generate more inflows in FX.
Right.
But if we can't solve that, we'll keep on having a drop in our foreign reserve figure, which in turn affects the exchange.